The US is entering a period in the economy where it might be too difficult to come back from. Like literally, like I'm talking about, we might enter a full-on depression. I mean, look at this. Goldman Sachs and JP Morgan can't survive a bank run. On top of that, we also just had the Federal Reserve raise their base interest rates by 25 basis points, bringing up the overall Fed's fund rate from 4.75% to 5%. And some projections are now estimating that the federal funds rate will be going into well above 5% by the end of 2023, meaning that they're not just going to raise interest rates one more time. As of right now, the Federal Reserve is saying that they're going to raise interest rates one more time in May by 25 basis points, and then the plan is to pause for the remainder of the year. Now, we're also going to be watching this video with Clear Value Tax. We're going to be doing some commentary, going over exactly everything that he breaks down, because it is really important to understand where the Federal Reserve is now, where the economy is, and what these implications could possibly be. Because again, the Federal Reserve right now is literally between a rock and a hard place, like Clear Value Tax talks about, where we have crazy runaway inflation, but now we're having an actual economic crisis within the economy. I mean, we're having banks go under, and many people are worrying that if these interest rates continue to be raised without any type of pause, without any type of pivot, that we're literally going to have a credit crisis and more things are going to crumble, which, as we know, is never a good thing. I mean, look at what happened in 2008. We've had about 10, 12 years of really good economic prosperity. So we're due for a pretty decent, correction. Obviously, we had COVID. That was a black swan event. But this would be something structural. This would be something that legitimately broke in the economy and forced everything to crash. So with that being said, make sure you guys buckle down. We are going to be watching this video. If this is your first time on the channel, make sure you guys drop a like, subscribe if you haven't subscribed, and as always, hit that push bell notification icon so you guys can get notified to all these time-sensitive videos, because some of these videos, they are quite important. Like it could literally mean like you getting the warning to get out of some of your positions days, if not weeks before, while everybody else is screaming that, hey, Bitcoin's going to go to $1 million, like we've been seeing, all over Twitter so far, or some of these moon boys, talking about on YouTube that, hey, this is the reason that this altcoin is going to do a 10,000x overnight for no good reason. Guys, I'm here to set it straight for you. Right now, the economy is not doing well at all. I mean, if we could just take a very quick look here, as we can see, like the SPY, it's having trouble kind of breaking above this 420 level. Ain't that a coincidence? But it's been trying to test this 420 level. But look, guys, the overall trend is still down. I mean, even if I just draw a very basic trend line, if my trading view were to work here, the overall trend is still down, guys. And it's not going to be changing probably anytime soon until we get some sort of relief. Now, many were very excited when this happened right here, where this first original trend line, it basically got invalidated, right? And it got invalidated sometime around January, where we had that crazy pump both in Bitcoin and stocks as well, as we can see. But what happened? It looked to be a false breakout, right? We had a breakout, and what do we always want to do before we buy in? We look at the breakout, we wait for the retest, usually look to get in here to then expect it to push forward, but it looks like it fell right back through. It's now trying to make another push upward, but I doubt anything is going to really come of that. And then even Bitcoin as well. I mean, taking a look at Bitcoin, we're still rejecting that 28K level. Everyone is calling for 30K Bitcoin, 31K. I saw some estimates as high as like 38,000. Guys, the economy's not doing well. Interest rates are still raising, interest rates are still being raised. People are spending less money because they just don't have any more money. They're having to take on credit cards. Pretty soon, they're going to learn that, hey, this 24% APR that I have on my credit card, it's not sustainable. Like, I'm going to have to pay that back at some point. So this is the issue right now that many people are, kind of ignoring. They're trying to push it to the back and hope that, all of their problems will be solved by ignoring it. But unfortunately, that's not how life works. You have to, face your problems head on. So let's take a listen to what Clear Value Tax talks about in this video. And then, we're going to be doing some commentary on top of that. So let's buckle up, guys. Now, quick disclaimer, guys, I am going to play this in 1.5x speed. So if you do watch this video faster than normal, it might sound extremely sped up. So just fair warning there.
In today's video, we're covering the stock market based on the newest variables. So here's the current situation. At their last meeting, which just happened a few days ago, the Federal Reserve raised interest rates by 0.25%. So the Fed funds interest rates is now at 5.0%. So that's at the top end of their range.
So let's take a look at that really quick. So as you can see right here, you can actually go to this website, the NewYorkFed.org. This is going to give you a lot of information on what the Federal Reserve is doing. And then as you can see, since they had their Federal Reserve meeting only a couple days ago, we are currently sitting right now at that 5% level. And if we even do go look at some of these other predictions, you can see that the federal funds rate is going to be at 5.25% after May. So if you actually come to the CMEgroup.com, It's showing you the target rate probabilities for the 3rd of May when they're going to have their next FOMC meeting. And right now, it's actually pricing in and projecting that the Fed's not going to raise their interest rates. So what you have is about a 93% vote that the federal funds rate, come May, is still going to stay, at that 5% level even after that meeting. And only about 7% have voted that they're still going to increase. But Jerome Powell has been very clear that they are going to increase their interest rate hikes at least one more time this year. And the plan is after that is to continue basically just to keep them there. And then if we look at June as well, basically, the market is pricing in right now that again, that if the Fed wasn't to raise interest rates, they're going to keep it there. But once again, just to clear it up, they are planning on raising interest rates at least one more time. And then the question after that is, hey, are they going to continue raising it, or are they actually going to pivot? So let's get back to the video.
So the Federal Reserve updated their economic projections. They're expecting that interest rates will peak at 5.25%. That means that the plan is, well, this is their plan, at their next meeting in May, raise interest rates one last time by 0.25%. And that would get us from right now from 5.0% to 5.25%. And then after that, the plan, according to the Fed, is to maintain interest rates there at 5.25% for the rest of the year. So we're talking about for at least 7 months. Stock market investors are skeptical. That's what the Federal Reserve said. That's their plan. But the stock market, the investors do not believe that this is going to happen. The market says that it is more likely than not that at the next meeting in May, the Fed will not raise interest rates. Instead, that the Fed will pause at 5.0%. The odds are currently a pause, a 64% chance of that happening. They raise interest rates by 0.25%, a 36% chance of that happening.
So this is the disconnect that's happening right now between regular investors and the overall markets and the Federal Reserve, is that every trader right now and even every influencer, they have this thing on their shoulder where they think that they can outsmart and outpredict the Fed, where literally Jerome Powell for the last 4 or 5 Fed meetings has said inflation's our number one priority and we are not stopping raising interest rates for the foreseeable future. We are going to keep raising them until we feel like we got inflation under control. However, every time there's some sort of event that happens in the economy, every single time that either something breaks or some sort of new data comes out, all of these traders, all of these influencers, all these investors, they start throwing out numbers like, oh, the Fed's now going to have to pivot. It's going to cause QE, and we're going to see these crazy highs again. Like for instance, when the banking crisis happened, everybody started calling for like 100K Bitcoin, $1 million Bitcoin, even though the Fed is still very clear they're going to keep raising interest rates. So this is a disconnect right now, is that the market is pricing in a Fed pivot or even a Fed reversal, right? But the Federal Reserve is saying the complete opposite thing. So it's almost like, who are you going to bet on? Are you going to bet the market being right, or the actual people telling you what is going on and how they're going to keep moving forward?
Now listen, the Federal Reserve raised interest rates by 0.25% on Wednesday, right? Going into that meeting, that was the expectation, that the Federal Reserve would raise interest rates by 0.25%. The market said a 65% chance. So that was the expectation, 65% chance that they would raise interest rates by 0.25%. And that's what the Fed did. But even though that was expected, still, the market did not like that. And the stock market had a really rough day, a really bad day on Wednesday. It ended up deep in the red. Now imagine how the stock market will react at the next Fed meeting if the outcome is worse than expected. Imagine that the expectation is overwhelmingly in favor of the Fed not raising interest rates, and then the Fed raises interest rates, and that would be a disaster, at least in my opinion.
So again, this is where a lot of sheep are getting led to the slaughterhouse, is because regular people, they're not really necessarily doing the deep dives like this, like, watching the FOMC meetings. They're not doing their own research. They're relying on like an influencer, somebody in YouTube, somebody that they kind of been following for a long time, that they happen to make money with. They're relying on them to give them the most credible predictions as to what the Federal Reserve is going to do. So that's a very good point that he made there. If everyone's going to keep betting that the Fed is going to pivot, and then the day comes and the Fed's like, yeah, we're not pivoting, what do you think is going to happen? It's going to be a massive sell-off. It's something that we even saw just now. Why do you think the stock market ended up so deep in the red? Is because so many people expected a Fed pivot because of the banking crisis, and they came out and did 25 basis points. We're lucky they did that. I was actually thinking they would do 50 basis points, but they only did 25. If they did a 50, people would have been wrecked.
So I already told you what was going to happen on Wednesday. I gave you fair warning in advance. I said that the Fed will do 0.25%. I said if the Fed did 0.5%, it would crash the stock market. It would trigger the circuit breakers, so they're not going to do it. I said that if they go at 25 basis points, the market's going to go up, and then it's going to drift down lower that day. So at the May meeting, if the market expects a pause, and the Fed raises, then it's going to be ugly. It's going to be a bloodbath. The stock market is basically setting itself up for a crash in that event.
So that is what we call exit liquidity. When you have this ramp up in prices of an asset, whether it's the stock market, Bitcoin, crypto, whatever, and anticipation of some sort of event, anticipation of some sort of announcement, And then when that event or announcement goes the opposite way, you see a sell-off. That's called exit liquidity. So all of this, propping up that's going to be happening now, going into the summer months because of a potential Fed pivot, it's just going to be exit liquidity. It's the big whales, the institutions, the big boys with a lot of the money. They are basically pushing a lot of these narratives. They want, this chirping going out there so all of us can start putting our money in, betting that the Fed's going to pivot, that prices are going to go super high, while on the way up, they're going to be cashing out their positions. It's so simple. You got to be able to see through that.
But I want you to know this because obviously this is very important. The pain in the stock market, it may come sooner, and here's why. Because by April 12th, we'll have a good sense of what the Federal Reserve will do at their meeting in May. April 12th is when the March inflation report comes out. So that report, it better show really good progress on lowering inflation. So if that CPI print isn't at 5.7% or below, then we're going to have some serious problems in the stock market. If it reads at 5.8%, then it could be a bad day, but if it's 5.9% or higher, then it's going to be ugly. We're going to crash.
And the inflation that came out for the month of February was literally 6% on the dot. So, if inflation only ticks down like 0.1% or 0.2%, it's going to be a big issue because it's showing and confirming that getting from that 6% down to like the 5s and the 4% is going to be a much bigger battle than it was getting inflation down from like 9% down to 6%. And that's been a theory that's been going around, is that we're seeing such a good progress and improvement in inflation right now, but the real battle is going to be, once we get to these like lower percentages, like really starting to make like progress down, like significant progress down.
If it's at 5.9% or above, that means the Federal Reserve will need to raise interest rates by 0.25% at their next meeting in May. And the market will come to that realization with the high inflation prints. And listen, I'm telling you, the Federal Reserve, they better get inflation down to 5.7% or below in March, because this is the easy part. The difficult part is going to be getting inflation down meaningfully when we're in the 5% range, because that's when we're in the 5% range, that's going to be the harder part. That's going to be when inflation becomes stickier. Now, we need to talk about the Fed pivot, because this is where things get crazy. To me, this is absolutely nuts, because the market expectation versus what the Federal Reserve is saying is worlds apart. So let me tell you what's happening. At the Federal Reserve meeting in June, the expectation is a 55% chance that interest rates will be at 5.0% and a 20% chance that the Federal Reserve will cut interest rates down to 4.75%. But remember that the Federal Reserve is signaling that in June, interest rates will be at 5.25%. So as a matter of fact, the Federal Reserve is saying that interest rates will be at 5.25% for the rest of the year until at least December. Now, this is what...
And that's where the disconnect is happening. So again, we can go and take a look at this chart one more time. This is exactly what I was showing you. So what he's saying is that in the summer months, the market is supposedly pricing in that, interest rates are going to be at that 5% level. And right now they're pricing in that there's a 75% chance that come June 14th, during the next Fed meeting, that the interest rates are still going to be at 5%. There's only a 4.4% chance they're pricing in that it would be, 5.25%. And there's a 20% chance that they are projecting that there's already going to be a pivot at that point. So this is the big disconnect right now that we are having in the markets.
To know this, the market is saying that by the July meeting, there's a 100% chance that the Fed pivot starts by then. A 100% chance that the Fed cuts interest rates by that time. Again, by July, the Federal Reserve is saying that interest rates will be at 5.25%. The market says that interest rates will be at 5.0%, a 15% chance, 4.75%, a 48% chance, 4.5%, a 33% chance, 4.25%, a 4% chance. The market is not even giving a 1% chance that interest rates will be at 5.25% at that time. So like I just said, it's worlds apart, the market expectation versus what the Federal Reserve is signaling. So the market expectation is a Fed pivot will happen by June. If not by then a 100% chance that it will happen by July. But Powell said no Fed pivot in 2023, that interest rate cuts are not in the base case scenario. So if the Federal Reserve doesn't start cutting interest rates by then the stock market is in serious jeopardy of crashing. Therefore, if inflation does not come down hard in March, then that's going to mean big trouble for the stock market, because expectations are extremely optimistic right now, as you can tell.
And again, not to beat a dead horse, but this is the big disconnect that we are seeing. We're seeing the stock market say something completely different. They're saying that, hey, we're going to have a Fed pivot. The markets are going to be back. We're going to get back into QE, and all assets are going to start to rally like crazy. But the Fed is literally saying the complete opposite. They're saying, we are not pivoting. There's no pivot that's going to happen. Best case scenario, we're going to pause interest rates just to kind of see if anything is going to break, and then we'll maybe consider doing a pivot. This is the big disconnect. Now, if we look at it historically, what has happened every single time? People have been wrong every single time they predicted a pivot. So why would this time be any different? Now, the only reason that this time would be any different is if we literally have a legitimate meltdown leading up into these next Fed meetings. If we literally see a bunch of banks going under even more, and I'm talking large banks, right? We just saw kind of the small regional banks go under. if we're going to start seeing like, big name banks like maybe Chase start to have issues, PNC Bank, Regions Bank, Wells Fargo, like if these banks start to have issues, then that would be, justifiable for a Fed pivot. But at the moment, we can't do it because inflation is still too high.
Another way that this could all play out is if the economy just collapses. If something breaks, then the Federal Reserve will have to slow down. They'll be forced to slow down. They'll have to pause and not go to 5.25%, or they're going to have to pivot sooner than they would like, so most likely in 2023. And that is a real possibility. Just look at what is happening in the banking sector. And even as of today, even the bigger banks are feeling it. Well, this is in Europe, but look at Deutsche Bank. Look at what's happening there. So in this scenario, a Fed pivot...
Now, for those of you who aren't aware, this is what happened at Deutsche Bank. So Deutsche Bank actually had their shares fall because it is becoming a lot more costly to insure against default. So this is what we had happen with Credit Suisse, where you saw a huge spike in credit default swaps. And basically what a credit default swap is you're buying insurance in the event that a bank goes under, right? That you're not able to access your monies anymore, your deposits anymore. So that's what credit default swaps are, is you're buying insurance on the bank that's already supposed to insure your money. Isn't that a little weird? And that's what's happening at Deutsche Bank right now, is that it's tumbling in price because the cost to insure against these spikes is starting to go through the roof. Everyone's like fleeing to insurance to ensure that they are not going to get screwed by the
would not trigger a market rally. It would not trigger stock market rally. The Fed pivot, it would be in response to a disaster, and it would be too little too late. And this is what historical data shows, that bull markets do not begin with the Fed pivot, but months after. So please note that everything I just told
you. And that's exactly true. When the Fed pivots, that is like when something has finally broken. And usually what ends up happening is there's already a sell-off heading into a Fed pivot, and then when the Fed does finally pivot, it's like a confirmation that, okay, things are really bad, and the sell-off continues. This is where it's a very big disconnect again, is many think that, a Fed pivot means that, okay, the bull market's back. No, it means we have like literally broken something. Like we are hitting rock bottom. And it's going to continue like that for at least like the coming months until something stabilizes, until some sort of aid or God forbid a bailout comes out. And then, things tend to reverse from there.
It's just stats or facts or market expectations. So honestly, there's not much to argue with here. But if you want my opinion, I'll give you my opinion. Okay, this is what I think. Here we go. I think that the Federal Reserve is stuck between a rock and a hard place. And the rock is hyperinflation and the hard place is economic depression. The Fed will try to avoid, obviously, they're going to try to avoid hyperinflation or economic depression. And you know where they're going to take us? They're going to choose the path of stagflation. So I believe that we'll have economic contraction and elevated inflation, which is stagflation, which is inflation in a recession. So mark my words, you're going to hear that word in the media. It's going to be popping up much more, just more and more. Stagflation. Just be prepared to see that word. The mainstream media is so predictable.
So let's go over what stagflation is as well really quickly. So as we can see right here, the Google definition is persistent high inflation combined with high unemployment and stagnant demand in the country's economy. So that means that inflation would maybe still stay at around this like 6% level, but then what we're having unemployment tick up. At the same time, our GDP is going down, meaning that we're not really producing as much and we're not exporting as much. We're not getting as much trade. And that is the worst case scenario. When inflation is super high, but then the cost of goods is actually also increasing and unemployment is increasing. So meaning people are not going to not only be able to which would mean that people are not only not going to be able to afford the cost of goods, but they're also not going to be able to get a job. So their purchasing power is going to completely dwindle. It's going to go to nothing. And just like it says right here, is that economic policymakers find this combination particularly difficult to handle, as attempting to correct one of the factors can exacerbate the other. So what that would mean is like if we do have stagflation, they can't just turn the money printer back on, because then you're going to exacerbate the situation of inflation being high. You can't just turn on the money printer just to get people back into jobs, because they're going to be getting back into jobs, but then you're going to have runaway inflation. So that's why it is so difficult right now what the Fed has to determine and make the best choice in this situation.
So I believe that for the Fed and for the politicians, stagflation, it would be a better outcome than hyperinflation or economic depression. The Fed, if they really wanted to stop inflation, they could reduce the money supply, or they could impose stricter reserve requirements on the banks. That would stop inflation just like that, but that would cause a depression. That would not cause a recession. That would cause an economic depression. Obviously, they don't want that. And on the flip side, the Federal Reserve, they can avoid economic collapse by slashing interest rates and by printing more money. But we all know what the consequences would be. That would agitate inflation. That would take us to the brink of hyperinflation. So the Federal Reserve, they're going to choose the best bad option, which is going to be the slow strangle of stagflation. That's because it's not going to be as dramatic as economic collapse, economic depression, or hyperinflation. But it's going to be very painful for everyday hardworking Americans. It's going to be especially difficult for people on fixed incomes, such as retirees or Social Security recipients. And it's going to be very difficult, most difficult for lower income Americans.
And this is also what Jerome Powell is talking about he was speaking before Congress with Elizabeth Warren, and she was grilling him. She's like, "You're trying to raise unemployment. You're trying to put 2 million people out of jobs." And Jerome Powell was trying to explain that if we don't handle inflation, it is going to be something that is felt by literally every single person in the United States of America, like well over 300 or 400 million people in this country. Versus if we do try to handle inflation, yes, there's going to be unemployment and there's going to be a couple million people that get affected, but the goal of getting this inflation down will save the pain that the rest of the United States would feel. So it's like that saying, you sacrifice the few for the many. It's like, is it worth it to make that trade? Historically, it's almost like what you have to do, because if we don't get a handle on inflation, the United States is going to start to lose its role as a reserve currency of the world. And the last thing that the U.S. wants to do is to lose its dominant power as the world reserve currency. I mean, we're already seeing what China and Russia is doing. Russia just announced that they're going to be settling a lot of the trade in Asia, Latin America, and Africa in the yuan, in the Chinese yuan. And trust me, the U.S. does not like that. So you already combine superpowers like Russia and China getting buddy-buddy, deciding to settle trade in a Chinese currency, at the same time mixed out with the U.S. losing its purchasing power. It's not setting up to be a really good recipe here for the United States in the next couple of decades.
So I believe that Jay Powell and friends will try to fight inflation for as long as they can until something breaks. In terms of the stock market, I believe that's going to drive the S&P 500 down to at least 3,600. From there, I'm just going to assess how bad the situation is. We have highly optimistic expectations propping up the stock market. It's just setting itself up for a big disappointment. That's just my opinion. We're going to see how Q1 corporate profits and margins are in a few weeks. I don't think that they're going to be pretty, and I think that Q2 is actually going to be worse. That's actually the consensus, so that's not going to be a shocker.
And what he's saying there is, earnings for quarter two do tend to happen like around May or June, and now we're going to be getting earnings reports from companies that have been feeling the effects of these raising interest rates from the last couple of months, specifically these last 3 months. Q4 reports came out back in like February, and it already wasn't looking that good at the end of 2022, and now going into 2023. We've been raising interest rates for a whole entire year, and a lot of these companies, they've been, consistently reporting lower sales, lower revenue, lower guidance. So, Q2 is only setting up to be much worse. So then when we see companies report even worse and worse, again, the stock market is just going to continue to sell off.
Agree with the consensus on this one. So at this moment, I would do two things. So the first thing is I would be heavier in cash right now. The purpose is straightforward. It's to have reserves to take advantage of fire sale prices in the event of a crash. The second thing I would do, I would encourage everyone to have some silver or some silver plays. That's because if the Federal Reserve tries to save the economy with their magical printing press, then we're going to get more inflation, and that's going to be great for silver. I like gold too, but I like silver for the industrial applications. But long story short, we are on a sinking ship. So market expectations are too optimistic. I don't think that we'll get a Fed pivot until something breaks, and if something does break, then we're going to go down. And the Fed pivot, it's not going to save the day. Corporate profits are going down, P/E ratios are still high, unemployment is going up, GDP will slow, that's the consensus. So you saw the trouble. You're seeing the trouble with the banks. Well, to me, none of this seems like a soft landing. But just to give you the whole...
And yeah, the soft landing narrative, it's going out the window, because how can you possibly have a soft landing when inflation is still super high, banks are collapsing, at the same time, unemployment is going through the roof. I mean, employment's only ticked up ever so slightly, but unemployment, it starts slow and it happens all at once. It just goes crazy. So again, that analogy of a sinking ship is true. Johnny actually made this post. Let me see if I can find it. So this is the analogy that Clear Value Tax was talking about in the sinking ship, where basically everyone at the end is saying, hey, if we're sinking, why are we 200 feet in the air? It's because it's the last thing to go down, right? The analogy of the sinking ship is perfect, is because it's the very beginning that many people forget about. They all run to the back, but what ends up happening? They still end up going down with the ship.
The storm. The worst thing that you can do is panic sell. You do not want to panic sell. But we encourage people to hedge against the crash because we see the stock market going lower. Just telling you for preparation purposes. And we encourage people to have reserves to take advantage of market panic when the time comes. Best time to buy is when there's blood in the streets at fire sale prices.
And that's true. So that's why the saying, cash is king is very true, is because when these types of events begin to happen, buying, during these discounts, that's where the biggest opportunities are going to present themselves. You're going to see, especially a lot of cryptos down like 95, 98%. Now, you don't want to just go ahead and start buying everything out there, because as we know, not every crypto does tend to recover. But the gist is the best opportunities come when the market breaks, because that's where the next set of millionaires is made. So I just want to go over that. Like, again, just do not fall for these narratives. Like, if something does break, if something does happen and somebody's screaming for a Fed pivot overnight, just understand, let the Federal Reserve make that decision. Do not let some influencer, do not let some macro guru tell you what is and not going to happen. The Federal Reserve has been very clear. They're going to raise interest rates one more time, and then the plan is to hold them there for the rest of the year unless something changes. And if something does change, then that's where we're going to have to be ready to adapt. So I want to leave you with that, guys. So as always, if you guys appreciate the video, make sure you guys drop a like. If not, leave some constructive criticism in the comments down below, and I'll catch you in the next one.